What if the real danger behind the cycle that predicts every major crash isn't what you see in headlines, but the quiet shifts happening underneath? It doesn't announce itself with headlines or breaking news. It starts as a small distortion, a change in how money moves, where credit flows, and how confidence quietly disappears from the system. At first, nothing feels different. Markets still trade, banks still function, and politicians still promise stability. But beneath that normal surface, the same ingredients that fueled previous crashes and collapses begin to line up: rising fragility, growing imbalances, and risks being pushed into corners where almost nobody is looking. History shows that these kinds of signals almost always lead to the same ending, even if the timeline is never exact. By the time the average person realizes something is wrong, the smarter players have already moved, the damage is already spreading, and the question is no longer if there will be consequences, but how deep they will cut. This video breaks down those early signs, connects them to what is happening right now, and shows you why ignoring them might be the most expensive mistake of this. The modern financial system often appears orderly, predictable, and firmly under control. Markets open each day, prices fluctuate within expected ranges, and institutions communicate confidence through carefully chosen language. To most people, this creates a sense that economic stability is a permanent condition rather than a temporary phase. Yet history shows that stability itself can be misleading. Major financial collapses rarely begin with chaos. They begin during periods when confidence is high and risk feels distant. Economic cycles have existed for as long as societies have traded resources. Periods of expansion encourage optimism, and optimism reshapes behavior. Businesses invest aggressively, households borrow with fewer reservations, and governments expand spending under the belief that growth will continue indefinitely. As long as conditions remain favorable, these decisions appear rational. Rising asset prices reinforce the perception that wealth is being created faster than obligations. Over time, optimism hardens into expectation, and expectation becomes dependency. This is where the foundation of the cycle begins to form. Growth that depends increasingly on borrowing rather than productivity becomes fragile. Debt allows future income to be spent today, shifting risk forward in time. When future income grows as expected, the system remains stable. When it does not, the imbalance becomes exposed. The danger lies not in borrowing itself, but in assuming that borrowing can expand without limit. Historically, early economies were constrained by physical resources. Gold, silver, land, and agricultural output imposed natural limits on monetary expansion. When rulers exceeded those limits, they diluted coinage or raised taxes, weakening trust and slowing trade. These adjustments were often gradual, but their consequences were unavoidable. Economic reality always enforced balance eventually. As financial systems evolved, those physical constraints were replaced by confidence-based systems. Banking allowed credit creation beyond tangible reserves. Paper currency represented value rather than containing it. These innovations increased efficiency and supported large-scale growth, but they also introduced vulnerability. When value depends on belief, stability depends on confidence remaining intact. By the time modern central banking emerged, economies had become deeply interconnected. Credit flowed across borders, linking distant markets into a single system. This connectivity amplified both growth and risk. Leverage became embedded in financial structures, magnifying returns during expansions and losses during contractions. Each cycle grew larger than the last. Central banks were designed to manage these dynamics by stabilizing credit and smoothing volatility. Their interventions reduced short-term damage but altered long-term incentives. Markets learned to expect support during downturns. Risk appeared manageable, and leverage increased further. Over time, debt accumulation became structural rather than cyclical. This is the earliest stage of the cycle that precedes major crashes. It is subtle, quiet, and widely misunderstood. Nothing appears broken. Daily life continues uninterrupted. Yet beneath the surface, the balance between growth and obligation begins to shift, setting the stage for what comes next. The cycle deepens when credit expansion continues after productive growth begins to slow and returns no longer justify the scale of borrowing embedded within the system. because debt then serves to preserve expectations rather than to expand real economic capacity in a sustainable way over time and across cycles globally. This phase is often mistaken for stability because headline indicators remain positive, unemployment appears contained, and asset prices either rise or hold steady, masking the structural shift from income-driven growth toward debt-dependent maintenance that quietly reduces resilience throughout households, corporations, banks, and public institutions simultaneously over time periods. Financial innovation frequently accelerates this transition by spreading risk across multiple layers of the system, creating the appearance of diversification while actually linking balance sheets, funding channels, and counterparties so tightly that stress in one area quickly transmits to others, amplifying shocks instead of absorbing them during periods of strain. As leverage rises, financial performance becomes increasingly sensitive to small changes in interest rates, cash flows, and confidence, meaning that conditions once considered manageable can produce outsized effects when growth slows or liquidity tightens unexpectedly within highly leveraged structures that depend on continuous refinancing to function smoothly over extended periods. At this stage, risk is not eliminated but postponed, as policy intervention, accounting adjustments, and optimistic assumptions delay recognition of losses, allowing imbalances to compound until they reach a scale that limits available responses and reduces the effectiveness of tools designed to restore stability during earlier phases of the cycle. Central banks play a critical role here by influencing credit conditions, yet their actions often reflect constraints imposed by existing debt levels, political pressures, and market expectations that support will arrive quickly whenever stress emerges, reinforcing behavior that encourages further leverage and dependence on favorable financial conditions continuing indefinitely forward. When slowdowns begin, they are often dismissed as temporary because models trained on long periods of stability fail to capture nonlinear responses, leading decision-makers to underestimate how quickly tightening conditions can cascade through funding markets, asset prices, and employment once confidence begins to erode across interconnected financial networks globally. This misjudgment delays adjustment and increases eventual severity because imbalances continue growing while signals are ignored, ensuring that when correction finally arrives, it must resolve a larger gap between financial claims and the real capacity of the economy to support them through income, production, and sustainable cash flows over time. During this phase, behavior changes subtly as institutions prioritize short-term performance, liquidity management, and reputational signals over long-term resilience, reducing investment in productive capacity while increasing reliance on financial engineering to maintain appearances of strength in an environment that is becoming progressively more fragile beneath its calm surface. Together, these developments define the middle phase of the cycle, where nothing appears broken, yet the conditions necessary for a major crash are quietly assembling through accumulated leverage, compressed risk premiums, and confidence that rests on continuation rather than fundamental balance within the financial system over time horizons people rarely. The next stage of the cycle emerges when accumulated fragility begins to interact with external pressures, revealing weaknesses that were previously hidden by favorable conditions and steady liquidity across markets and institutions. These pressures do not need to be dramatic. In fact, they are often ordinary developments such as modest interest rate increases, slower revenue growth, or declining demand in a single sector that expose how dependent the system has become on continuous expansion. At this point, the system's tolerance for disruption is low. What once required a major shock now requires only a small deviation from expectations. Debt that appeared manageable under optimistic assumptions becomes burdensome as cash flows tighten. Refinancing that once seemed routine becomes uncertain. Asset prices that relied on cheap financing and confidence begin to stall or reverse, undermining balance sheets across multiple layers of the economy simultaneously. This phase is particularly dangerous because its signals are often misinterpreted. Early warnings are framed as healthy corrections or temporary adjustments rather than structural stress. Policymakers and market participants focus on restoring momentum rather than addressing underlying imbalance. The desire to return to previous conditions delays recognition that the system itself has changed. As confidence weakens, liquidity begins to retreat. Institutions reduce exposure, not out of panic, but prudence. Lending standards tighten. Credit availability narrows. Risk premiums increase. These changes reinforce one another, producing a feedback loop that accelerates deterioration. Each defensive move by one participant increases pressure on others, spreading stress through interconnected networks. At this stage, financial markets often display heightened volatility without clear direction. Prices fluctuate sharply as participants reassess risk, yet no consensus forms about the future path. This uncertainty undermines long-term investment and encourages short-term behavior. Liquidity concentrates in perceived safe assets, draining support from more vulnerable areas of the system. Employment effects typically lag financial stress, which contributes to misjudgment. As long as jobs remain plentiful, the broader public perceives stability. By the time labor markets weaken meaningfully, financial conditions have already deteriorated substantially. This delay reduces the effectiveness of corrective measures and increases the likelihood of deeper contraction. Governments face growing constraints during this phase. Fiscal capacity is limited by existing debt burdens. Political pressure intensifies as conditions worsen. Policy responses become reactive rather than strategic. Efforts to support growth compete with the need to maintain credibility and control inflation, narrowing available options. Central banks encounter similar limits. Tools that once stabilized markets now risk unintended consequences. Reducing rates may fuel inflation or asset distortions. Maintaining restrictive conditions may accelerate defaults. Each choice involves trade-offs that cannot be avoided once leverage reaches elevated levels across sectors. The defining feature of this stage is the erosion of confidence without collapse. Systems continue to function, yet belief in their stability weakens. Market participants remain active, but cautious. Households continue spending, but with restraint. This ambiguity often persists longer than expected, reinforcing the illusion that a full reset can still be avoided. However, history shows that once fragility reaches this point, resolution becomes unavoidable. The cycle has advanced beyond prevention and entered a phase where outcomes are shaped by how adjustment unfolds rather than whether it occurs at all. The final phase of the cycle is not defined by collapse alone, but by reflection and consequence. Once the system has adjusted, societies are forced to confront the reality that financial stability is never permanent and that growth built on expanding claims must eventually reconcile with real economic capacity. This realization often arrives after damage has been done, shaping behavior long after markets have stabilized and headlines have faded. In the aftermath, priorities shift. Households become cautious, focusing on savings and security rather than leverage. Businesses emphasize balance sheet strength over rapid expansion. Governments reassess fiscal commitments, at least temporarily, under pressure from constrained resources and public scrutiny. These adjustments restore a measure of discipline that was lost during periods of excess. Yet time plays a powerful role in shaping memory. As years pass and conditions improve, the urgency of caution diminishes. Innovation and optimism return. New financial instruments emerge, promising efficiency and resilience. Risk appears manageable again. Gradually, the same behaviors that fueled previous cycles resurface, often justified by claims that circumstances have fundamentally changed. This recurrence does not reflect ignorance so much as human nature. Confidence grows when losses fade from experience. Incentives favor short-term performance over long-term stability. Political systems reward immediate results rather than distant resilience. These forces ensure that cycles persist even when understanding the cycle that predicts major crashes is therefore not about predicting exact events or timelines. It is about recognizing conditions. Elevated leverage, slowing growth, concentrated risk, and limited policy flexibility signal vulnerability regardless of prevailing optimism. When these elements align, the probability of disruption increases even if triggers remain uncertain. This perspective encourages a different relationship with financial systems. Instead of assuming perpetual stability, it promotes awareness of trade-offs and limits. It highlights the importance of productivity-driven growth, prudent risk management, and institutional transparency. While these principles cannot eliminate downturns, they can reduce severity and improve recovery. Crucially, This understanding reframes fear. Crashes are not mysterious forces that strike without cause. They are consequences of accumulated decisions made under incentives that favor expansion and delay adjustment. Recognizing this empowers individuals, institutions, and societies to approach financial cycles with humility rather than denial. The cycle that predicts every major crash operates quietly during periods of calm. It advances not through dramatic signals, but through routine decisions repeated across millions of actors responding to the same incentives. By the time consequences become visible, reversal is no longer possible, only adaptation. Ultimately, financial systems endure when they balance confidence with constraint. Growth is healthiest when it reflects real capacity rather than borrowed momentum. Stability is strongest when it is acknowledged as temporary rather than assumed permanent. The lesson of every major crash is not that collapse is inevitable, but that imbalance always demands resolution. The cycle does not punish ambition, innovation, or growth. It responds to excess, denial, and the belief that limits no longer apply. Understanding this does not grant control over outcomes, but it provides clarity. And clarity, in a world shaped by uncertainty, remains one of the most valuable tools any society can possess.